everyone. My name is Ofa Bate Akosangaya. I'm a member of Group 9. The other members of my team are Dylan Outram, Anna Hurtado, and Stephen Hensley. Today we're going to be discussing the acquisition of Target by Amazon. Amazon Corporation was founded in 1902. Its headquarters is currently in Minneapolis. It's actually the 8th largest U.S. retailer with over 1,800 stores, employing about 345,000 employees, and is ranked as the 39th largest company in terms of revenue, to the tune of $71 billion. It's currently trading at $71.58 with a ticker symbol of TGT. Now, one of the reasons we think that this is a great acquisition is that recently Amazon acquired Whole Foods, and Whole Foods has a very similar demographics to Target. So we think Target will be a good opportunity for them. In addition to that, Target's e-commerce sector hasn't done very well in the e-commerce space. So it can actually take advantage of the opportunities that Amazon has to offer. Amazon, on the other hand, can increase its brick and mortar presence by acquiring Target, which would actually stifle its competition, Walmart. In addition to that, Amazon's strategic advantage, as we mentioned before, and its core competence really lies in logistics, and Target, on the other hand, is better at merchandising. So acquiring Target would give it an opportunity to improve its merchandising skills. So when we look at the SWOTs, we start with the strengths. We also mentioned before the 1,800 stores, which would be a great advantage for Amazon. Target has a high brand loyalty. In addition to that, in 2017, the cash flow increased by about 28%. Some of its weaknesses, the EBITDA, which decreased by 13%, and the changes in personnel, such as the CFO. There's also weakness in the e-commerce space, as we mentioned earlier. But this is also an opportunity because expanding its e-commerce would be a great opportunity for Target using the advantages that Amazon has to offer. There's also a perpetual agreement with CVS and Target, which would be a great opportunity for Amazon as well. Some of the threats would be increased competition from wholesalers such as Sam's Club and Costco, and again, the continued loss in revenue in the e-commerce space. Now, when we look at the financials overall, there are 4 main things that we can point out, and that's the net income increase for 2018 of 4.4%. In addition to that, there was an increase in revenue for 2018 as well of 6.6%. The EBITDA we mentioned before dropped by 13%, but overall over the last 4 years has actually remained neutral. If we look at the stock price, its evolution has been consistent and has increased positively over the last 4 years. I'm going to turn it over to Dylan now, who's going to go over the WACC and other financials. Thank you.
Thank you, Ofa. To begin, we first had to calculate the weighted average cost of capital. To do this, we first have to calculate the cost of debt. The cost of debt came out to 2.26%, which was based on the risk-free rate of 2.82% that was found on Bloomberg Financials. We then applied the 2018 tax rate that Target paid of 19.69% to this value and got the cost of debt at 2.26%. Next, we had to calculate the cost of equity. Cost of equity was calculated using the dividend discount model. As can be seen in the lower left, our dividend yield calculation comes from the dividends that were paid out in February 2019 and the stock prices of February 2019. This gave us a dividend yield of 3.52%. We then also calculated the 5-year growth of the dividends, which was 8.28%. By plugging these values into the dividend discount model, we get a cost of equity of 11.8%. Next, we have to calculate the weighted average for the percentage of debt and common equity to the market value. Once these are calculated, we sum up the WACC values to get a WACC of 9.36%. This is the rate of return that Amazon should require when acquiring Target. We also know that this WACC value is in the ballpark of real life because it compares favorably to Bloomberg's WACC of 9%. Next, we completed a discounted cash flow analysis. We used the WACC values along with a reasonable long-term growth of 6.56%. First, we had to calculate the free cash flow for 2018 and project that growth out 5 years to 2023. Next, we calculated the enterprise value, which is the sum of the present values for each of these years, free cash flows, plus the present value of the terminal value, which was calculated in 2023 based on the Gordon growth model. Once we got this number, we were able to add back in the initial cash and marketable securities, subtract out the liabilities, and to get the equity value. The equity value of roughly $42.5 billion was then divided by the shares outstanding, which were 522 million, and that gave us an equity value per share of $81.46. Next, we completed this sensitivity analysis, which you can see below, that shows how WACC and long-term growth affects our equity value per share. As can be seen here, as the WACC value increases, the per share value decreases, while as the long-term growth increases, the per share equity value also increases. Now we go to Anna for more financial analysis.
Thank you. So did absorb the enterprise value of the firm we're going to acquire directly with the FCFF method. Now, my name is Ana Paola Hurtado, and I'm going to talk a little bit about market risk and present the market approach analysis on next slide. First, the market risk. Market risk is the economic-wide sort of risk that affects everybody, not only a single stock, but the entire market. And that's what we call the systematic risk. The systematic risk is what matters and is the only risk that we are concerned with. So we measure the volatility or systematic risk of target stock price in comparison to the rate of return of the market portfolio by determining a statistical measure, the beta. Based on a regression analysis looking at the stock price movement of target versus the quote-unquote S&P 500 in the past 5 years. The beta we compute is historical, though is a measure to estimate the required return of the stock into the future. So this is what the analysis looks like graphically. Essentially, here we see that beta expresses the fundamental trade-off between minimizing the risk and maximizing the return. So target beta of 0.6 means that is half volatile as the market. Remember, the market overall risk is 1. So for example, if market return of 10% would mean a 6% gain for us, Amazon. And on the other hand, if the market return were to decline and provide a return of -6%, Amazon could expect a return of a loss of 3%. That's kind of the analysis. So the slope of this line represents the market risk premium, and the intercept with this line would represent the nominal risk-free rate available for the market. So overall, target risk versus expected risk plotted above this line would mean that it's undervalued because the investor can expect a greater return for this inherent risk, and below is overvalued because the investor would be accepting a lower return for the amount of the risk assumed. Now I'm going to continue with the multiple analysis, the market approach. Here we look at, we look at 7 companies that have very close enterprise value to target. And we look at the financial structure, we have the time frame, we have the last 12-month revenue, the last 12-month EBITDA, and we compute and come up with this range of multiple rents over here. And then we compute the implied enterprise value range by subtracting the debt and adding back the cash. And we were left with this value, implied enterprise value. Then finally, to come out with the equity value per share, we divided this implied enterprise value by the share outstanding 522 millions to get our range of prices between $48 and $177. So in a snapshot, essentially, our conclusion from this is in this graph, and we believe that Target is probably valued about correctly right now. Perhaps it's a little bit undervalued. Their share price is around 72.64 now, but our market approach and the income approach give values that are significantly higher. So that's why we believe it's a little bit undervalued, but altogether it's actually quite amazing how close all these methodology are to each other. So next, Stephen is going to finalize our analysis with the financial proposal and conclusion.
Thank you, Anna. Nice job. Based on our analysis and valuation, we believe a fair price for Target is $80 per share. This represents a 10% premium from the existing price share of $72.64. That being said, we'd go as high as $90 per share to complete the transaction. The screen that I am presenting now is the financing option to complete the deal. We looked at three options: 100% equity, debt equity combination, and 100% debt. Of the three, we feel that 100% equity and debt equity combination are the best options. So those are the ones that we will be presenting today. On the left-hand side is the 100% equity option. You'll note that it will take 25 million shares of new shares to complete the deal. This will increase the number of shares of Amazon from 491 million to 516 million. Combined earnings will be $10,082 million. Earnings per share will be $19.52, and the transaction is accretive. On the right-hand side is the debt equity analysis. In this scenario, 40% will be debt financed and 60% will be equity financed. The interest rate is 10.8%. The tax rate is 30%. To complete the deal, Amazon will issue 15 million shares of new shares. The combined shares outstanding will be 506 million. Combined earnings will be $8,814 million. Combined earnings per share will be $17.41, and this is also accretive. This slide here represents the $90 per share offer. On the left, you'll see it'll take 29 million shares to be issued from Amazon. This will mean the combined outstanding shares will be 520 million. Combined earnings per share will be $10,082 million. EPS $19.40, also accretive. On the right, 40-60 split again. Interest rate 9.6%. Tax rate 30%. New shares issued 17 million. Combined shares outstanding 508 million. Combined earnings is $8,814 million under this scenario. And EPS 17.34, also accretive. On the next slide, we're going to dive into the due diligence. These are key items that we identified. First and foremost, identify new organizational leaders that will hopefully join Amazon. New structure of the deal, how will it be structured. Maintain Target's strong brand name or change it. Relocate Target's headquarters. Identify technology to consider maintaining or combining. Review contracts and legal proceedings to identify risk. So these are the key points we felt were important for due diligence. The last slide is a summary of all the previous slides, sort of a closing. So we have presented multiple valuations that really strongly recommend the acquisition of Target. Combined earnings is positive, both earnings growth and EPS. The transaction is accretive even without synergies, which is very important and notable. Strengths and opportunities significantly outweigh weaknesses and threats. Leveraging Amazon's extraordinary market cap is key to the financing, we believe. And most importantly, the acquisition will result in long-term financial growth for investors. The team and I thank you for your time and attention. Thank you.